I'm Sana Kadri. I'm the founder of EdWatch that reignited hope for a better future in the most uncertain times of our lives. This year, we emerged as a futuristic skills development platform where we focus on global emotional intelligence, data science and machine learning, risk and IT security, and IFRSs. Assalamu alaikum and welcome to EdWatch Studio. We are here with yet another episode of IFRS Practical Issues series. Thank you very much for your overwhelming response on the last episode that we had. It went really well. And today again we are here with another episode of IFRS Practical Issues series with EdWatch, your online training partner that provides critical skills development solutions for digital transformation. So let's just get on to the query that we had. So just to give you an overview again, we discussed the queries on IFRS practical issues that we receive from our audiences who might be going through some tough situation at their work and they need to discuss it with us. So today we'll be discussing a very competent financial statements that's considered very simple, not very technical, but it becomes really technical and very difficult for it to be reconciled, and that's cash flow. It's really hard to reconcile cash flow, even harder than reconciling bank balance sheet, because balance sheet is coming from various other accounts, and we know that it's been recorded there, it has to be there. But cash flow is basically the presentation of cash position, cash movements, and you have to exclude the accrual and non-cash impacts to prepare a cash flow, and therefore it's really hard. It becomes really hard for it to be reconciled. And this I'm saying because of, based on my experiences as an auditor while I was working for an audit firm, and obviously I had the extensive experience of working in the financial reporting side in the financial services industry. So this is generally what I've seen is considered to be the last thing to look into after we are done with all the recording and presentations. Okay, so let's just jump into what we have today. So basically, again, as I mentioned that, cash flows are considered to be very simple components, but get very complicated to reconcile. It gets even complicated when you are consolidating the cash flows. You're consolidating cash flows for the parent company, and especially very complicated when the functional currency of the subsidiary is different from that of the parent company. So we'll be discussing today that particular issue. We received a query from one of our audiences, and I'll read that out loud for you. So the issue is that we have adopted as a case study. I would like to prepare a cash flow statement for an entity with many different foreign subsidiaries. The functional and presentation currency of the parent is US dollar, USD. However, subsidiaries use AUD, JPY, and GBP. Can you share a template for a consolidated cash flow and the steps needed to prepare a consolidated cash flow? Specifically, I want to know how to prepare a calculation to prove the effect of foreign exchange changes on opening cash balances in line on the cash flow. So just to be very clear here, we are here, the objective of this whole session is to give you a broader understanding of the accounting implications and how to deal with different accounting issues when preparing financial statements or making any transactions or recording any transactions. We are not here because the objective is basically to enable each and every accountant and finance professional to take the right decisions and make the right recordings. We are far ahead of the era where I was at a younger chartered accountant, younger finance professional stage. I wanted every different templates to calculate things for me. I wanted everything to be, sort of spoon fed to me. We want, more more professional, more knowledgeable accountants who are able to take the right business decisions, make the right recordings, and present financial statements with consistency and transparency to the stakeholders. This is what we want. This is what we are here for. I will be sharing a bit of a template. I do share templates in my training programs that I do as a trainer. But I would really appreciate it if you don't just focus on getting templates ready for us and, trying it ourselves. So let's just jump on to how we do it. So financial statements, when the functional currency is different from that of the presentation currency, IAS 21 is one standard that actually identifies how to do it, how to translate into a presentation currency when you are presenting financial statements. So the steps are very simple. For monetary items in the financial position of the balance sheet, you translate these items at the exchange rates prevalent at the close of the financial reporting period. And for non-monetary items such as investments taken at fair value and in the financial position and the profit and loss account, all items in the profit and loss account, you translate the items at the exchange rate prevalent at the transaction date, or where applicable, where not applicable, at the average exchange rate, and the difference is taken to the P&L. But it doesn't talk about cash flows. Why? Because cash flows are basically covered under IAS 7. I'll just read out for you what IAS 7 says about the cash flows. So it specifically says that the cash flows of a foreign subsidiary shall be translated at the exchange rates between the functional currency and the foreign currency at the dates of the cash flow, which means that the transaction date and where that's not applicable at the average exchange rate. So why is it different from profit and loss account? Because these are cash flows, these are cash transactions, cash movements, and some of the items to measure cash movements are for indirect method. Under indirect method, for the operating activities, are also taken from balance sheet. The net difference from opening and closing balances, the net from the balance sheet or financial position, which is again converted at the closing exchange rate. So it becomes complicated. How to do about it? How to translate cash flows in the presentation currency or the functional currency if it's the same as the presentation currency of the parent, when the subsidiaries functional currency is different, it's a foreign currency. So let's talk about that. Typically when I am actually delivering training, so I discuss it in a detailed stepwise process, but to simplify it for today's session, to make everybody understand what we're trying, how we can calculate that in a simplified way, we have simplified it into 3-step model, you could say. So the first step is you take the subsidiaries cash flows, which is in the foreign currency. You start from the very beginning. As far as the first item, which we take in the cash flows, which is profit before tax, you take it from the P&L, which is translated under IAS 21, at the transaction exchange rate at the transaction date or the average exchange rate. You take the profit before tax, that profit before tax. The rest of the items, you individually translate those at exchange rate on the transaction date, where applicable. Where it is not applicable, you take it average exchange rate, right? This is how you have converted each and every items of the subsidiaries cash flows translated into the functional currency or the presentation currency of the parent company. Now, when you do that, there will arise a difference. What is that? the difference is between cash and cash equivalents at the beginning of the period, plus minus the net the net cash flow change, the net change in the cash flows, minus cash and cash equivalents at the end of the period. These at the beginning and end taken at the closing exchange rates at the closing date, closing of the financial periods, relevant financial periods. So what is that difference? This difference is actually the exchange rate difference, exchange rate change, effective exchange rate change. And that's basically shown below the opening cash and cash equivalent amount. So this is how you've converted, you've got the effective change in exchange rate. Now what your second step would be? You add the parent company's cash flow items into the subsidiaries items. You consolidate it now that you have both the cash flows in the same currency. And the third step would be, which is always in the case of parent consolidated financial statements, you have to remove the intra-group transactions, eliminate the intra-group transactions from the cash flow. Impact of those transactions eliminated. Now you have the consolidated cash flows. So this is a very, very simplified version of the three-step process. Generally, people consider it is very complicated, but I've tried to make it more simplify this for you. And if you go to as the person who posed this question asked for a template, I just tried to create a simplified version of the template for you. I hope that helps. Although the objective is you to understand how it works and why it works. So the first step, take the foreign currency, subsidiaries cash flow in the current foreign currency, translate it into the functional currency of the parent or the presentation currency of the parent, add the parent company's cash flows and eliminate any intra-group transactions. You will have your cash flow of the consolidated cash flows. So I hope that helped, and I hope that was helpful for you to understand how it works. And this is what we had for today's discussion. I hope we have been able to discuss it in a much deeper way, in a much simplified way for each and every person in the audiences. Now, I'd like to just mention one more thing, that we discussed each and every standard in a much more detail. We have our courses. We have IFRS refresher that is scheduled in March, coming up, 2 days IFRS refresher that covers a large number of IFRSs. Then we have IFRS updates. It's a 3 to 4 hours online class that we conduct every quarter. We're discussing all the updates, latest updates in the IFRSs. Then we have other IFRS courses. Those could be customized, but they're available with us. You can always visit our website, www.ed-watch.org. Have a look at it. If you're interested, let us know what IFRSs you are interested in. Just register it online, or you can also send us an email at contact@ed-watch.org. For the next episode, we really wanted to, schedule another, because we have other, a large number of queries piled up. We wanted to hold one on 16th of February, but due to some occupancy, I couldn't. We might be coming up if that becomes possible for us. But one thing's for sure, we have one episode scheduled on March 9th. That will be on IFRSs. A lot of queries in IFRS 15. So that we will try to discuss one issue on IFRS 15 from a different angle. And if you have any query, if you are actually looking, you're stuck anywhere, you just want some clarity in your mind for any accounting or any other issue, just do visit our webpage that's specifically created for IFRS queries. You have there's this form that you can go and share your query. If that query is very, very urgent, should send us an email as well at contact@ed-watch.org, sharing the urgency of the query, and we'll try to get back to you. We always, when we are discussing any person's queries, we send in an email updating them. You can also share your contact number so we can, maybe call you if you are interested. We generally keep companies' names confidential because we just don't want to discuss, everything. We just want to focus on the clarity of the matter and get things resolved. So you can always get back to us on that. Do remember that we have these IFRS refresher courses and update courses coming up. And just visit us or send in your queries anytime you want. Thank you very much for joining us. It was a pleasure talking to you. It's a pleasure coming to doing this IFRS update session every time that we do. Thank you very much and take care. Have a nice day.